Well, good afternoon, everyone. So we have our last session and our panel, which we titled What Macroprudential Framework for Europe? And that's what we are going to discuss and assess from different angles. You may recall, at least the European ones in the room, that August last year, the Commission issued a consultation paper on the future of the macroprudential framework for Europe. It was a sort of oddly timed document in August, and not so much after the British referendum. But it had a view about the future of macroprudential policy. We ourselves at ECB, we issued a public opinion on that, not a public opinion, we reacted publicly in a written text to the consultation paper of the Commission. And there are many topics, of course, in the document. Let me just highlight 3 or 4 that could be part of the discussion, but in our reaction to the Commission's paper, we highlighted that we would like to see the recognition of the competences of the ECB in the macroprudential sphere, becoming a sort of another macroprudential authority in Europe, in particular after Brexit, because indeed we have legally the powers to top up national measures in the field of macroprudential policy, which now will represent, if you just measure it by the total amount of assets in the banking sector, it's 28 trillion. And the remaining EU countries that are not members of the euro area and the SSM perimeter represent only 3 trillion. After, of course, the UK goes out. So this, in our view, it's not fully recognized in the consultation paper. The second point is that we would like to see more European level competences in this field, particularly in connection with the CMU project, the Capital Markets Union, which justifies that more powers should be given to the European supervisory authorities, particularly ESMA, in view of that particular project. Because banking union and capital markets union are the main drivers of financial integration in Europe. And deepening financial integration as a result of both projects implies more interconnectedness and so more risks that have to be addressed at the European level. And that's why we should have in the other sectors what we more or less have now in banking and give more powers to these European supervisory authorities. Fourth point that we highlighted is that macroprudential policy should have a little bit more instruments than the ones that are recognized now in the European legislation, because the powers, for instance, that we have to top up measures taken at the national level refer only to the instruments that in the CRD4 are recognized as macroprudential instruments. And that's not all the instruments that possibly can be used for macroprudential purposes. So, in a nutshell, we thought that the document of the Commission was not sufficiently ambitious and did not recognize fully the new environment where we were, particularly after the British referendum. But it was, of course, the first step in a discussion, and I don't know how much Sharon Berrigan can tell us today about the assessment of all the reactions that they received and what they intend to do. But of course he knows everything because Sharon Berrigan is really the encyclopedia in Brussels of macroprudential policy. He has followed everything from the start, and good to have you here. So we also see these problems of addressing the framework of macroprudential policy in Europe, also from the angle of what national authorities are doing in certain fields, because that can also provide food for thought in what regards the type of instruments that are more effective and should, in our view, be also available to the ECB, and they are not currently. So we will have then in the panel Fernando Restoy, who is now chair or president, I don't know exactly what is the designation, but he is the head of the Financial Stability Institute at the BIS. And formerly, of course, he was in the board of the Central Bank of Spain, in charge of supervision, and as such, a member of our supervisory board in the SSM side of the ECB. Then we have Sharon Donnery, who is currently Deputy Governor of the Central Bank of Ireland, and has been also before alternate to in the supervisory board of the SSM, and is in charge of these matters, and has been also chairing and coordinating the analysis by the SSM of the NPL's problem. So she is really following macroprudential very closely. Then we have Paul Hilbers, who is Director of Financial Stability in the Central Bank of the Netherlands. So also on top, as such, he is a member of the Basel Committee. He also comes to our Financial Stability Committee, and then we have Sean, who is currently Director of precisely Financial Stability. So, without further ado, I give the floor to Fernando to kick off.
Thank you very much, Vítor. Thank you, organizers, for inviting me to participate in this conference. I must, according to the BIS rules, I have to stress that the BIS does not form any view on a specific national policy debates, and therefore what I'm going to say here represents only my own views and not the views of the BIS. When I was invited, actually, to participate in this, all I know what you meant.
Yeah.
Which one is it? Oh, that's the one. Oh, that's the one. So, when I was invited to participate in this panel, I was invited as well to start my presentation by referring to the current challenges of the European banking sector and how macroprudential policies could actually be used to address them. It was an interesting exercise. When I went to see what is the current challenges, the most important current challenges for the European banking industry, I came out with topics like non-performing loans, low profitability, sustainability of business models, or potential overcapacity. And frankly, those are not typically the issues which are normally addressed by macroprudential policies, which is good. I mean, just to put the limit for the scope of our discussion. I mean, even if we consider improve the macroprudential framework, there are still a number of important measures to be taken at the micro-pru level. And in fact, it's clear that right now, I mean, you don't see a need of bold action at the level of the Eurozone, at least in the macroprudential field. Of course, there could be some imbalances in different jurisdictions that can be addressed by macroprudential policies, but it's clear that there is no general need, actually, to be extremely active in the macroprudential domain right now. However, it's clear that the current monetary and financial conditions are extremely accommodative. We know that, and therefore that, in principle, could actually help generating some imbalances. So it's important, actually, the macropru is there to act if and when needed. So that's why I think that this exercise which now is now being led by the European Commission to modify the European framework for macroprudential policies is certainly very timely, and hopefully that will end up with a substantial improvement of the macroprudential framework. And when we talk about the macroprudential framework, of course, we have to actually refer to issues like the availability of instruments. Vítor already mentioned that. The allocation responsibilities between the center and the national jurisdictions, the coordination across different policy domains, and also the risk for circumvention. So what do we do with foreign institutions or with non-banks, in principle are not subject to macroprudential regulation. So what is the main features of the current European Union or Eurozone macroprudential framework? First, it's clear that, as we said, there is a limited toolkit. So essentially only capital-based measures are recognized in the European regulations, although there are much more freedom at the national level. Of course, they are free in principle to add instruments to the ones which are recognized in European regulation. Of course, macroprudential toolkit for non-banks is even more limited. That was stressed in this report by the SRB last year, although this may not be an issue. If, as some speakers this morning have said, actually, when we talk about macroprudential measures for non-banks, in principle, we are thinking about just the microprudential tools that will actually be activated following a macro type of motivation. Well, this is the case, of course, will be much easier actually just to be able actually to act also in the non-banking or the shadow banking sector. Third element is that the European regulation certainly recognizes the issue of the cross-border contagions, who had the reciprocity principle there that will allow in principle for all banks which are active in a particular jurisdiction to be subject to the macroprudential tools activated in that particular jurisdiction, regardless of whether actually they are branches, for instance, of foreign institutions. Fourth, this is important, is a fairly decentralized system. So the initiative always rests with the national authorities, and the ECB can only top up, but not top down, the measures taken at the domestic level. And also, as I said, it's asymmetric in the sense that the ECB can actually sort of strengthen the policy instruments, but cannot actually loosen the domestic actions. And also it's important to bear in mind that the ECB works on the basis of the separation principle, which is articulated around the concept of the no projection procedure, which is true that is quite clear, quite stringent, quite strong in what refers macro-prudential issues. The initiative is always with the single supervisory mechanism, with the supervisory board. In the case of macro-pru, there are more possibilities actually to the ECB to be involved in the discussions, in the process much earlier. So, of course, those features of the European framework in respect to macroprudential policies, as always, is a sort of a result of a combination of political and technical elements. Of course, we can discuss all of them in the discussion, but let me just concentrate on possible ways to strengthen this macroprudential framework by looking at the experience of countries which have actually activated macroprudential policy in the past, and more importantly on the empirical evidence which have been discussed in this forum this year, last year, in other of the many macroprudential meetings or seminars which have taken place over the last years. So when we talk about first on the nature of the financial cycle, which is obviously the sort of the framework in which we have to discuss the macroprudential policies, we have some stylized facts which are now very clear and almost accepted by everyone, every scholar working on this field. First, that certainly there are important differences between the financial and the business cycles. So typically the financial cycles tend to be longer and sharper than the business cycles. For instance, I can refer to this paper by Claessens, Boyle, and Terrones. But also it's true that the financial and business cycles are actually correlated. And in particular, recessions that take place when the financial cycle is in a downturn are particularly severe. And also it's true the financial cycles vary across countries within the European Union and within the Eurozone, although you can identify a cluster of some countries for which actually the degree of concordance of the financial cycles are not that small, are quite significant, even above 75%. I can refer to this paper by Schuller, Hilbers, and Peltonen on that matter. So what else? In terms of the effectiveness of the policy instruments, I think it's clear that macroprudential instruments obviously, I would say, work well actually to increase the resilience of the financial sector. Basically, they just basically limit the risk exposure by banks or increase actually the capital which is available actually to afford those risks. So in principle, by definition, almost they increase the resilience of the financial sector. So in terms of the proof objective of macro-proof policies, I think the evidence is quite clear, almost straightforward. There is some more debate about the effectiveness of the macro-proof policies in what respects actually smoothing out the financial cycle, in particular as to moderate credit expansions or credit contractions in the downturn, although I think the evidence by now, I think, is relatively supportive that they tend to be also effective for this macro objective, although again, the evidence probably is more dispersed, and the quantitative estimates vary sometimes in a significant manner. I think the evidence also shows that instruments that operate through quantitative restrictions, such as loan-to-values or debt-to-income, or the service-to-income, or concentration limits, tend to be more effective than those instruments that work through internal pricing within the banks, and such as capital buffers or changes in risk weights. I think there are some papers certainly pointing to that, and also I will refer to a very recent paper that has been just released in the BIS website by Gianbacorta and Murcia on the evidence actually obtained from Latin American countries. Another stylized fact from the literature is that among non-capital measures, debt-to-income seems to be more effective than loan-to-values. And this is not totally surprising, taking into account, obviously, that loan-to-values are also quite procyclical. Another element of the empirical evidence is that, in principle, macroprudential instruments work symmetrically. So, in principle, they help both actually to moderate the credit expansion in the upturn of the financial cycle, as well as actually to moderate the downturns in the financial cycle, to moderate credit contraction, although this latter effect seems to be less significant than the former, so that, in principle, probably due to the inability, actually, macro-proof policies to compensate for the lack of demand, well, what happens is that in the downturns, in principle, the ability to moderate credit contractions is less significant than the ability in the upturns, actually, to moderate credit expansions. I must say that looking at the Spanish experience, as you know, with the Spain actually was a country in which sort of the primitive sort of macroprudential policies were implemented before the crisis by the use of the so-called dynamic provisions. Well, the experience accumulated from that period is that it's broadly consistent with this empirical evidence, except for the fact that it was clear in Spain, actually, that this dynamic provision was actually more important to moderate the credit contraction in the downturn after the collapse of the real estate sector than this was more important than the effectiveness of the dynamic provision to moderate actually the credit expansion, so, which was quite significant. But in any case, I think more or less is consistent with this empirical evidence. So in sum, I think that available empirical evidence certainly strongly supports the addition of other non-capital-based measures to the toolkit which is available now for the European Central Bank. Certainly supports actually the fact of enlarging the set of macroprudential policy tools which are currently recognized in the European regulation. And by doing that, actually, we will will actually sort of take advantage of the experience which has been accumulated in many countries, recently in Korea, Canada, Brazil, New Zealand, Sweden, and even within the Eurozone in the Netherlands. Probably we will have afterwards actually a presentation on this experience. So it's clear that both empirical evidence cross-country plus the experience in several countries, what you observe is that actually you have a number of macroprudential policy instruments which are particularly effective, and in particular to moderate the financial cycle. And it's something very difficult to explain why those instruments are not available in the European regulation, why they are not available in particular for the European Central Bank. Also, I think that this empirical evidence supports pretty much symmetric macroprudential regimes, and therefore actually the possibility, for instance, for the ECB actually to top down as well as to top up the actions taken at the domestic level. I think that more or less, I think empirical evidence supports also the idea of decentralization to the extent that the financial cycles are not totally correlated across countries. But I think that when we talk about that, actually the degree of centralization or decentralization, macroprudential policies, it's important to keep in mind actually also the synergies, potential synergies with other policies which are conducted on a centralized fashion, in particular microprudential policy. As you know, with the SSM, this is centralized in Frankfurt, at least for significant financial institutions, as well as for monetary policy, obviously. So I think it's this idea of synergies of macro policies with other policies which are conducted centrally is relevant when we talk about the optimal degree of centralization also of macroprudential policies. But of course, this discussion is only relevant to the extent that this separation principle that I referred to before between different policy domains is taken in a pragmatic way. So you don't take it to read. So let me just spend 1 minute on that. So of course, that would be ideal. We know that we could actually identify 3 different policy domains: systemic financial stability, the situation, the solvency of individual financial institutions, and price stability. It would be great that we could separate completely those 3 objectives. It would be great that we could actually allocate different instruments to each of those policies, because by doing that, we could actually sort of give a very specific mandate to a particular agency, actually to try to address that objective without much need of coordination. But of course, as always, the world is more complex. We see that the policy's objectives are interrelated, that, as we saw, the financial and business cycles are correlated, that financial stability can be affected by both macro as well as micro developments, and also by monetary dynamics, obviously. But it's not only that, it's that the policy instruments which are actually used in different domains often coincide. This is certainly the case of interest rates, certainly drive both. We know that, the financial and the business cycle. And when you talk about actually the identification of both the business and the financial cycle, you see that interest rates explain both financial and the macro cycle. Second is that many macro tools, such as the capital add-ons or the leverage ratios or concentration limits, those are also microprudential tools. And when you talk about strictly about micro policy tools like Pillar 2, I mean, you are actually by conducting these microprudential policies, actually you are also affecting obviously the macro environment. Just to give you an example, when you have actually the Pillar 2 decision, you have a component of this Pillar 2 decision here at the ECB, which is called a Pillar 2 guidance, and the magnitude of this Pillar 2 guidance is actually calculated on the basis of a stress test. It's clear that by just calibrating the degree of severity of the adverse scenario of that stress test, basically, you are requiring all banks across the board more or less capital. So when you are operating this Pillar 2, a pure micro policy tool, you are obviously affecting macro conditions. So there's always this interaction between the micro and the macro. And actually, we know that even formally in the legislation, the Capital Requirements Directive, Articles 97 and 98, is even recognized that the Pillar 2 could actually be conducted to follow actual macro consideration. So it's not actually tailored to individual institutions. It's recognized in the directive that could actually be used in a different way. So I think it's clear that by the interaction of objectives and instruments, you see that there is no possibility to properly conduct the macroprudential policies if you don't actually have sufficient coordination with the other policy domains. In other words, I mean, this system of objectives and instruments cannot be solved recursively. I mean, it's just a simultaneous equation model, so you better actually get the right coordination to do everything properly. So I think all those point to the need actually to take the separation principle in a pragmatic way. Of course, you have to be mindful of all the institutional, legal, and all types of considerations which are obviously relevant. It's important, this argument basically says that you need actually to protect the reputation, the credibility of the central bank about conducting monetary policy. You cannot sort of introduce excessive burden on the central bank. You cannot pollute actually the nice monetary policy function by these nasty financial stability things. All those are arguments which are obviously well taken, but at the same time I think it's clear that from the point of view of effectiveness, you better ensure a good coordination, and in particular a good preparation of decisions in different policy domains by ensuring the right actually communication between people in charge of the preparation of different policy decisions. People at the micro side and the macro side, they should talk together, exchange analysis, exchange information and data in order to be able to take the relevant decisions in a proper way. So just to be more concrete, and I finish with that, I think it's important that when addressing this issue of improving the macroprudential framework in Europe, so we concentrate on increased effectiveness. That's important. So let's better actually look at the evidence, what type of instruments are more effective and what other instruments are less important. Important to favor coordination, to facilitate coordination, not only actually across countries, but also across policy domains. And certainly we have to obviously respect the deep legal and philosophical constraints which are very relevant, obviously, in the European Union. Certainly, I think there is a case to keep decentralization. So probably we should keep this feature that national authorities are the ones which take the initiative. Well, in principle, this could make sense. It's more or less consistent with empirical evidence on the degree of correlation between financial sectors, financial business, financial cycles across countries. But as important as that, of course, to enhance as much as possible the ability by the ECB to smoothen the euro area business cycle, as well as to facilitate the right coordination of all actions taken in the macroprudential domain in the national jurisdictions. And for that, certainly you need actually to allow the ECB to use non-capital-based measures, which are the ones which are going to matter, which are going to be more effective. Second, important to be able to loosen national actions, even if in practice this may not always be very relevant, certainly less relevant than the previous proposal. Also, it's important to try to limit potential leakages through the operation of foreign banks or non-banks, so that to some extent to strengthen the macroprudential framework, you have to see ways actually that some measures could actually be imposed also on non-banking financial institutions. Certainly here the operation, non-capital-based measures may actually help. That will be more suitable actually to be applied for institutions which are not subject to capital regulation. And important, of course, the ECB take seriously those powers and be sufficiently proactive when utilizing the available ability actually to favor actually systemic financial stability for the whole Eurozone. And then a big challenge is, of course, communication. For communication, I think it's important actually that we put emphasis in conveying a message of adequate coordination of different policy domains. Maybe at present it's not that relevant, but in the future, whenever more active or more significant macroprudential policy actions will have to be taken, I think it's important that from the ECB it conveys a very clear message for the markets, but also for the public in general, actually, and that those different measures taken are consistent with the measures taken in other fields, so people actually feel comfortable on how the ECB is actually conducting all its responsibilities. And ideally, of course, this has been mentioned this morning as well, we would like actually to have some progress in the definition of something close to a macroprudential policy target. We know that this is very difficult, but it's probably something which is badly needed in order, in particular, actually, to enhance the accountability of the agencies which are responsible for macroprudential policies. Thank you.
Thank you very much, Fernando, for having given us this overview of the setup that we have in Europe. I think it will facilitate the continuation of the discussion because it saves others to repeat some elements of that framework. So now I give the floor to Sharon, please.
Thank you, Vice President, and distinguished guests. It's a pleasure to be here to speak to you on the panel this afternoon, and many thanks for the kind invitation. So I think, as we've been hearing at the conference, significant progress has been made in recent years in developing the EU's macroprudential framework, and I think much credit for that must go to institutions like the ECB and the ESRB and the European Commission, as well as to the national macroprudential authorities. Now, the manner in which we now conduct macroprudential policy emerged in the context of the global financial crisis and recession. And the relative impact of these and the interaction with diverse domestic factors has led to a policy framework which I think in broad terms shares common themes and objectives while also reflecting important country and region-specific characteristics. So it's timely that we now consider our broader framework in the EU as the economic recovery has become more firmly established and as we see a normalisation of the financial cycle. And at the same time, we're potentially presented with a broader range of more diverse sources of risk than when the parameters of our current framework were being designed. These include the increasing role of non-banks in financial intermediation and the challenges arising from the decision of the United Kingdom to leave the European Union. So to date, we've learned a lot by doing, and indeed a lot has been done in the establishment of the framework and the activation of various macroprudential policy instruments across the EU. But today I'd like to focus my remarks on some of the challenges in implementing macroprudential policy, particularly through borrower-based measures for the mortgage market. As some of you may know already, the Central Bank of Ireland introduced caps on loan-to-value and loan-to-income ratios in early 2015. And both the introduction of the measures and the first review of them, which we undertook in 2016, threw up some interesting challenges, some of which I plan to share with you here today. They include the need to frequently communicate on the objectives of the measures and the need to regularly review both their impact and effectiveness. And more generally, I think some other challenging issues with respect to these instruments also include whether there should be a more coordinated European framework for their introduction, as we've just been hearing from Fernando. So borrower-based measures such as loan-to-value and debt service-to-income, debt-to-income or loan-to-income ratios have been introduced in a number of European member states over recent years. Prior to the financial crisis, these types of measures were mainly deployed in non-European countries, including, for example, South Korea, Hong Kong, Singapore, and a number of others. And there is certainly empirical evidence regarding their potential effectiveness in reducing risks to financial stability. The evidence, however, is rarely clear-cut, and the impact of such measures can vary depending on, among other things, the characteristics of national housing markets and the position in the financial cycle. So while subject to intense debate when we introduced the mortgage measures in 2015, the legacy of the financial crisis in Ireland was still to the forefront of many people's minds. And I think that this, to some degree, facilitated the subsequent broad societal understanding and acceptance of our measures. Now, our two primary objectives when introducing the measures were first, enhancing the resilience of households and banks to economic and financial shocks, and second, reducing in a structural way the pro-cyclicality that can be inherent in housing and credit markets by capping the amount of high LTV and LTI mortgages allowed at any one time. However, while we have emphasised in all of our public communications that it is not our objective to target house prices, this has proven, in fact, to be a very difficult message to get across to the public. Underlying much of the public discourse on our mortgage rules is the central issue of affordability. And in this context, it has been challenging for us to explain that house prices are determined by a complex interaction of both supply and demand side factors, that although our measures may impact on prices, that is not their primary goal, and that housing market policy issues like taxes, building measures, and the shortage of supply of housing for buyers and renters are outside of our remit as a central bank. Now, our view is that not only would it be extremely difficult to choose an appropriate target for house prices, but also extremely difficult for us to hit such a target. Financial sector regulations cannot really address these issues, which must instead be addressed by other targeted policies. And to banks, we have also had to carefully explain that these are limits and not targets, and we continue to monitor the risk appetite of our banks in this regard. So, figure 1 here shows the recent history of property prices in Ireland, and it also shows some uptick in mortgage lending across some segments of the market. Although the overall numbers remain modest because of the scale of deleveraging following the crisis, the volume of new lending is now going up. In terms of transactions in Ireland, cash buyers continue to account for a very large relative proportion of activity at around 42% in 2016. So given these market dynamics, existing supply constraints and strong demand factors are unlikely to moderate significantly in Ireland in the short term. And I think this requires us to reinforce communications of the objectives of our measures. Now, in terms of their design, our measures create a framework which allows us to better take into account the balance of risks in the economy by adjusting the parameters according to current market conditions. Having this type of flexibility, I think, is particularly important for a small open economy like Ireland. The mortgage measures are also complementary to our existing macroprudential supervision and to lenders' own risk management practices. They are not intended to capture all aspects of credit risk associated with any individual borrower, nor to replace or substitute for a bank's existing internal credit assessment policies and procedures. Rather, they are designed to reinforce and strengthen the existing suite of credit risk mitigation tools that are employed by prudent lenders. Following the crisis, we also introduced comprehensive loan-level reporting requirements on the main Irish banks. This data provides us with information on a wide range of loan characteristics, including, for example, outstanding balances, loan terms and loan repayment for the population of mortgage and consumer loans. And these data are critical in the calibration and evaluation of our measures. The activation of our central credit register in June will further enhance our analytical capacity with respect to our evaluation of the measures and may also facilitate us in moving towards a debt-to-income ratio in the future. Now, our measures, as initially calibrated, set out a loan-to-income ratio of 3.5 times income as the anchor of the framework, with the value of loans that could exceed the LTI limit of 3.5 not greater than 20% of new lending in any given year. This only applies to primary dwelling homes, and there is no LTI limit for investment purchases. And Fernando, in his remarks, already mentioned the importance of LTI or DTI in terms of their effectiveness. In addition, a maximum LTV of 80% was set for non-first-time buyers, and for first-time buyers, a higher cap of 90% applied for house purchases for the first €220,000, and the 80% LTV then applied for that part of the value of the house which was above €220,000. And banks were allowed to issue up to 15% of their primary dwelling home loans above the LTV limits on an annual basis. We apply a more stringent limit to the purchase of houses for investment purposes, and here the limit is a 70% LTV, with up to 10% of new lending on this basis allowed above the limit. Now, at the time of the introduction of the measures, we also committed to regular reviews of both their impact and effectiveness. This, we believe, represents good practice and mitigates against any potential inaction bias. It's also consistent with the commitment for quarterly reviews of the countercyclical capital buffer setting and the annual reviews of the identification of and the buffer setting for other systemically important institutions as prescribed in the CRR and CRD. The review process was overseen by our new Macroprudential Measures Committee and involved a range of analytical projects that looked at issues like borrower impact, the early performance of our measures against the stated objectives, and any side effects, including in relation to impact on the rental market or other leakages. And to enhance transparency and understanding, our research outputs on all of these issues and records of the meetings of our Macroprudential Measures Committee are all published on the Central Bank's website. In addition, feedback from external stakeholders was gathered through a call for evidence on the impact of the measures. And submissions were received from a variety of property and construction industry stakeholders, financial services firms and groups, political parties, government departments and academics, and also individual members of the public. And the submissions were a very useful input for our review and were all also published on the Central Bank of Ireland's website. Now, it's obviously the case that it was very early after the introduction of our measures to be able to find much causal impact. But I would say our review still threw up some interesting findings and resulted in some changes to the design of our policies. So firstly, we saw a reduction in high LTV mortgages, and simulations from loan loss forecasting models indicate that the resilience of banks and households have both increased. We found that the introduction of the measures had an immediate and material impact on moderating price expectations. Actual price increases also moderated, although it is more difficult to describe any causality to our measures. In general, we found that the overall framework of the measures is appropriate and effective in meeting our objectives. Nonetheless, following the review, some changes to the parameters were applied to improve the sustainability and effectiveness of the overall framework. Most notably, the higher 90% LTV available to first-time buyers is now available at all prices. This change was in part to avoid a situation whereby the €220,000 cut-off point would have had to be recalibrated at regular periods as house prices increased. And this particular change was also supported by new research findings of lower credit risk for first-time buyers at all house price levels. The other main change arising from the review was to the structure of the proportionate caps, such that instead of an LTV allowance of 15% for all owner-occupier mortgages, separate allowances for first-time buyers of 5% and second and subsequent buyers of 20% are now allowed. And we made some other technical amendments in addition. High levels of household indebtedness and a large number of households in mortgage arrears and/or with negative or low levels of positive equity in their houses remain prominent features of the Irish residential real estate market. So whilst not materially affecting the amount of allowances available, the differentiation of allowances of first-time buyers and second and subsequent buyers allows for a more precise calibration of our rules by borrower type if in future they need to be tightened or loosened in response to emerging risks or other developments in the property market. Negative equity borrowers are also exempt from our measures, and as more second and subsequent buyers move from negative equity into small levels of positive equity, the higher level of exemptions we allow will ensure the measures do not act as an excessively binding constraint. Now, taking communication and calibration together, I think people broadly understood the rationale for the limited refinements and the minor recalibration of the framework. However, with such levels of house price increases, as you saw on the slides earlier, we found the need to communicate that policy stability is important for both households and banks. As central banks, we have a responsibility to reduce regulatory uncertainty, and therefore we think annual reviews are the most appropriate. In the case of the LTV and LTI caps, it's intended that the annual review will allow us to evaluate the structural design of the framework, analyse any side effects or unintended consequences, and assess whether the parameters are calibrated appropriately for current housing and credit conditions. The experience in Ireland so far corresponds with the broad international experience as to the effectiveness of borrower-based measures for a mortgage market given country-specific features. A framework for transparent and accountable policy making in this space, supported by consistently communicated and well-defined objectives and a related evidence base, are necessary conditions for their acceptance and effectiveness. At present, national macroprudential authorities play the central role in implementing borrower-based measures. The ESRB, of course, has an important coordinating role via its notification process, and national authorities also benefit from their deliberations and interactions with the ECB. The ECB, as we heard already, also has an important top-up power with regard to the capital-based instruments like the CCYB and the OC buffers. The impact, though, of borrower-based measures when they are binding is much more evident to the public at large than capital and liquidity restrictions which are imposed directly on banks. Borrower-based measures can also have important distributional and welfare effects in society, particularly in relation to access to home ownership. And I think these particular factors underline the importance of getting the design of the measures right, taking into account country-specific factors, and also the need to communicate the overall framework and ensure it becomes generally acceptable in society as a permanent feature of the mortgage market. So, as well as the wide range of national specific institutional features which influence the design and calibration of such instruments, this suggests that responsible authorities must also be accountable at national level. Although we should be humble enough to acknowledge that the interactions between macroprudential policy measures may not be fully or correctly identified ex ante. Significant progress has been made in the analytical toolkit to support macroprudential policy across the euro area, as was outlined in some of the presentations yesterday. I think as policymakers we should continue to draw on this input, encourage its development and understand where judgment in evaluating policy's impact, effectiveness and interactions is necessary. In this regard, particularly as we are still in the early days of an active macroprudential framework in Europe, we should aim to avoid underlaps to ensure systemic risks are mitigated. As the framework develops in the EU, national designated authorities should continue to have a sufficiently broad set of tools to target identified systemic risk. I think we should also continue to learn by doing, combined with a commitment to regularly, rigorously and transparently review our policy measures. We will ensure the most effective tools are in operation, both in isolation and jointly, to mitigate systemic risk. So, to conclude, today I've touched on a number of challenges we have before us when considering the appropriate policy framework for Europe. Now, as we well know, past performance is no guarantee of future returns. However, I think we can look back on the first generation of our macroprudential policy framework and how it has been adopted at both national and union level in a broadly positive light. Important features should remain, such as the prominent role of national authorities in identifying systemic risk and designing policy measures, effective cooperation in the euro area and ESRB, and the appropriate acknowledgement of the implications of our policies in other dimensions and countries. While the challenges we face are ever-changing, the foundations we have laid and the commitment shown over the past few years can give us confidence going forward. Thank you very much, Vice President, and thank you for your attention.
Yep. Thank you very much, Sharon, for sharing this experience, which is very important because it's one of the examples that we have had in Europe of effective policies. As I recalled yesterday, 9 member countries adopted measures using LTVs, DTIs, LTIs, since we started to have competences in this matter. I give now the floor to Paul. Yeah, and you need the remote. Please.
Thank you, Vítor. I would like to be a bit maybe more practical in my presentation and run through the experiences that we have had with our housing-based macroprudential policies. I jotted down 3 questions. I have to apologize, I don't have too much math in my presentation or charts. We've had quite enough of that so far, so I hope you can bear with me with these relatively simple slides. 3 questions, and the reason I put them there is that, and the point already came up in previous presentations, communication is very key, I think, in this area. To be able to explain what you're doing to the public, to the politicians, to the financial sector, when you develop these new instruments is very, very key to their success. And that's why I thought it would be useful to have these 3 questions worked out a bit further in our national context. why macroprudential policy and the focus on real estate and what can you do there, and also the issue of possible spillovers. In terms of what we did in our institution, in our central bank, we did basically three things. We started analyzing macroprudential relationships much more in the financial stability department. We started issuing twice a year our overview of financial stability, and we started developing a macro register of issues that we wanted to focus on in our analytical work. Secondly, we set up 2 coordination committees for macroprudential policies, one of which is an internal committee that consists of members of the supervisory departments of the bank. We are, as you may know, an integrated supervisor. We do both supervision and monetary policy. So the supervisory people are in there, the payment system people are in there, the macro and monetary people are in that committee, as well as the financial stability people, because we thought it's very important that we create a sufficient base for these policies also within our own institution. And secondly, we have a more national coordination committee, the Financial Stability Committee, that meets 3 times a year. It consists of the central bank, the governor is the chair of that committee. It consists of the Authority for Financial Markets, our Conduct of Business supervisor, and the Ministry of Finance. And as a fourth party, and I always have to explain this, we have a Central Planning Bureau in Holland, which sounds a bit old-style Soviet, but it is really an economic think tank for the government, and also that institution is represented in our Financial Stability Committee. And we issue a report after each meeting, and that report is subsequently sent to the Parliament by our Minister of Finance. So we don't publish the minutes, as Sharon just mentioned, but we do issue a paper that summarizes our deliberations. That's on the coordination mechanisms. And thirdly, on the development of instruments, we have so far developed both capital-based instruments. We have in place a systemic risk buffer in our country, which is 3% for the major banks and 1% for the somewhat smaller banks, but still relatively big and systemic institutions. The countercyclical buffer is formally introduced but set at 0. And in addition, it's the topic of this afternoon's discussion, I think we have also measures focused on the housing market, real estate measures, on which I will elaborate a bit more. It is our experience that, as I said at the outset, you really have to create support, explain, or you might even say, sell macroprudential policies to your system. It is something relatively new, and it's been our experience that it's not an easy sell sometimes. People are used to monetary policy, interest rate policies. People are used to microprudential policies. But to explain macroprudential policies is sometimes a bit of a challenge, and we've certainly spent some time on that over the past few years. And we have not been 100% successful, I should say. There is still somewhat hesitance, in particular with regard to our LTV measure that we introduced a few years ago, in terms of the acceptance by the public, by the financial sector, by the politicians of that particular measures. And that's also why we are very, very pleased to see the ECB, Vítor, also Sergio, to really promote these policies, because that helps us tremendously, as does, incidentally, what the IMF is doing with its FSAPs and its focus on financial stability. It's very key to us in terms of being able to explain what we're doing, and the support we get from those institutions is very vital to our work. Now, let me then turn to why macroprudential policy. Very briefly, we explain most of what we do with a reference to the crisis. And here you see 4 blocks of reactions to the crisis that we have undertaken in recent years. Of course, the first one and the most, I would say, the gut reaction of any supervisor is when there's a financial crisis to increase the requirements for capital and also under Basel III for liquidity. So that's something that we've done in the context, of course, of the European discussion, in the context of the CRD4 and CRR. That's the, I would say, the more straightforward reaction. What we've also done is we have introduced a novel approach to supervision. Incidentally, we were supported by that, by an interesting paper by the IMF, the fund, with the inspiring title, Learning to Say No. The title of the paper was Learning to Say No, and it was addressed at supervisors who apparently, in the view of the IMF, didn't say no enough. Well, at least it helped us, that paper helped us to tighten, become more intrusive, become more conclusive in terms of our conduct of supervision. That was the second block of reactions to the crisis. The third is more forward-looking supervision. We also noticed that the traditional supervision and the traditional regulation is very much focused on capital and liquidity, and in a sense you might say that it's backward-looking. In the capital ratios and in the liquidity you see what has happened in the past, but you don't necessarily see what's coming in the future. So we've been trying to think of more forward-looking elements into our supervision, and we came up basically with three, I would say. The first two you see in the third block. We focus much more than we used to in our supervision on business models of banks, business models of financial institutions, because we feel that if you get a feel for the business model of an institution, you also get a feel for whether risks are being identified, are being addressed, are being mitigated by the institution. And we also, and that's I think maybe more well known, our country is also focused on elements of culture, behavior, governance in the financial sector. Now, I should say on these 2 points, these are difficult elements of supervision. It is much easier to raise a capital requirement than to start supervising conduct and culture in the financial sector. So it's not an easy thing, but we feel that by doing it, you would get more of a forward-looking impact on the stability of your financial sector. Now, the last point, and I said I had three elements, the last of the three is the fourth block, enhanced macroprudential oversight, and that's the topic of this afternoon's and these 2 days conference. We also introduced macroprudential analysis and macroprudential policies because we also feel that macroprudential is very much a forward-looking element into regulation and into supervision. For instance, through stress testing, which is a key instrument of macroprudential supervision, you get a feel for how the sector is affected by changes in the environment, by changing in market prices, by changing in scenarios, by changing in the economy. So that instrument, I think, is a very clear example of an element of more forward-looking supervision that we also introduced in my country. Then turning to real estate, turning to the housing market, what have we done there? Well, first let me say that it's our strong feel, it's a strong position that housing markets and real estate markets are very key to financial stability. I think it's also been the outcome of many studies conducted by academics, by the fund. I recall Reinhardt and Rogoff, for instance, but also other papers, that there's hardly any financial crisis that didn't have some real estate component to it. So I don't think it requires much convincing to see that there is this financial stability angle to it. But also, and we have witnessed that very much in our country, there's also strong impact on the economy, on the economic developments. We have seen in our country economic developments being very positive and prosperous during times when house prices were appreciating. And we thought we did a very great job as macro policy makers, because the economy was growing, unemployment was low, and we did everything quite well, it seemed. But I think in hindsight, a lot of that was really the result of appreciating house prices. And we noticed that during the period of 2008-2013, when house prices were coming down, because then we saw the same reaction, but in an opposite, or the same impact, but in an opposite direction. We saw a stronger decline in activity, a stronger softening of growth and employment developments than we had expected. And that again supported us in our view that one has to also from a macroeconomic perspective be very well aware of the impact of housing market developments, real estate market developments on the economy, on economic cycles, and on the financial cycle. Now, looking at housing markets, I should say, and it was already mentioned also by previous speakers, these markets differ a lot between countries. I would say that of all the financial markets that we look at, foreign exchange markets, interest markets, derivative markets, the difference between countries is largest probably in real estate markets. And that has to do with the impact of legal differences. There are large differences between the rules for home ownership, the rules for transacting real estate, There's the whole issue of single recourse versus double recourse, which makes a tremendous difference in terms of the stability of the market and the collateral, the security of the collateral in a country. And these differences between countries are large. So when you think about international agreements on rules for housing markets, you need to keep that in mind, that these differences are quite large. And not only there are legal differences, but there are also, for instance, important tax differences. And sometimes I feel that tax, although it's a word that doesn't really is referred to much in these discussions, tax is for housing markets a very key variable. And let me give you one example from my own country. We have had, and we still have, a very generous deductibility of interest payments on mortgages. And that by itself is a tremendous incentive for people to borrow and buy houses. And even to some extent to an irrational level. I mean, people are so keen to avoid paying taxes that they might put themselves in a very expensive house, which of course they may enjoy, but they may also not be fully aware of the risks that they run, and also that the banks may not appreciate the risks that are associated with that. But that's a very strong incentive too, and also a very strong difference between countries. And a third element I want to mention is cultural differences. Cultural differences also play a role in housing markets, in behavior of the population and households on these markets. And for instance, in my country, people are very keen to own a house. And that's already very different when you go to our neighboring country, Germany, which is a renter's country. We are an owner's country. It's very hard to be called a very successful Dutch when you don't own your own house. I'm sorry to say maybe, but that's the way it almost seems to be. And that's very different in other countries. And that by itself drives also these markets, these cultural elements that are internationally different between countries. Of course, these differences in culture, in tax, and in legal aspects also drive differences in things like LTVs. We have a very high LTV ratio in my country because people really like to borrow, as I said before, for their houses. So we have had LTVs up to 120% in the past. People basically bought the house, they paid all the taxes on the house, they paid all the renovations on the house, they bought a car and a boat, and then they were done. And then they had 120% of LTV. I'm exaggerating, of course, but that's the way the system worked in practice at some stage. And we really felt we had to cut back on that. So we have in place now a policy that brings down the LTV, and you need to understand me right, because many people don't understand the numbers, from 106 to 100. And many people think I make a mistake. I should say 94, because how can you have 106? But we really had a policy in place to limit LTVs to 106 up to a few years ago. We're bringing it down by 1 percentage point a year. So this year, 2017, the LTV maximum in my country is 101. And next year it will be 100. Now, we have been recommending through the Financial Stability Committee that I mentioned earlier on to bring it down further to 90%. We have been supported in that intention by the ECB, by the IMF, by almost practically everybody else outside of our country. I must confess, within my own country, the applause is less clearly audible. This is really something that is a very difficult element, as I said before, because of the reasons, to be accepted by our population, by our financial sector, by our politicians. We will continue to push. We hope that you will continue to push also, but it's important. But my point is really these markets really differ because of these reasons, and the policies also for that reason need to be adjusted to some extent to those circumstances. Incidentally, we're also reducing this tax deductibility very gradually so, and we are also having new amortization rules. We have also rules that limit interest-only mortgages. So we're doing a lot of things actually to bring our markets to a more stable and more, I would say, internationally comparable system. But it's a somewhat slow process, and we have to keep pushing. So what are the lessons? I think housing markets are very different, but are very relevant from a macro perspective. So we need to look into those markets from a macro viewpoint. They differ widely. Tax is a very important incentive. And also, in a recent study, and I just want to mention this very briefly, but we issued a study a few days ago on, and this is an important topic, and it was quickly raised by Paul Tucker this morning, we see a large discrepancy between developments in major cities and in the rest of the country. So when you talk about house prices, this is always a talk about a sort of average. I think it's also interesting, at least to note, if not to think about whether there is any policy implications, the difference between housing price developments in major cities and in the regions. Now, very briefly, and I just need one more minute maybe, on a final topic that is also related to the housing market issue in my country, which is the spillover issue. Should we have macro-pru policies beyond banking? I can already reveal the answer that I would give to that question, which is yes. I think this is important. Why is it important? In my country, we clearly see that when we tightened up the rules, the capital requirements on banks, you see, for instance, this mortgage market move out of the banking sector towards insurance and pensions. There's a very clear shift because of the differences in regulation between these various sectors. Is that something that is wrong? Is that something that shouldn't be there? I don't think so. I think there can be good reasons why, for instance, insurance companies and pension funds which have long liabilities also are in search of long assets, and mortgages are generally long assets, at least in my country. Yeah. So it's not that there is something wrong with it, but we need to be aware of this, what I would call waterbed effect, when you tighten rules in one part of the financial sector on other parts. And if there are financial stability implications, you should also consider whether you should not do something about those implications in those other parts of the financial sector. So I think macro-pru policies beyond banking are required. And as already mentioned also by Sharon and previous speakers earlier in the conference, it would be good to also consider more borrower-based measures and activity-based policies in addition to the more traditional lender and entity-based policies. Just final point on the implications of our experiences for the EU. I think housing markets are key, so it's very useful that the Commission also is currently thinking about measures aimed at those markets. I think it is a useful addition to have not only capital instruments but also non-capital instruments of a macroprudential nature. And lastly, communication is really key. And you have to explain these new instruments, and you have to spend some time on that, spend some energy on that to be able to have them land in the right way. Thank you very much.
Thank you very much. Yes, you are right with your last point and all the others, but indeed it is in a way strange that apparently it's easier to communicate monetary policy, which in some circumstances has more material consequences, including from a distributional point of view, but of course is covered by the tradition of monetary policy being sort of a more mysterious and so not immediately understood in its all consequences, whereas macroprudential policies of this nature are so explicit that are immediately understood by public opinion. So, last but not least, certainly, now we are eager to hear from the Commission what Sean Berrigan can tell us about what will be the future of the macroprudential framework in Europe. Sean, and thank you very much for coming.
Thank you, Victor, and thank you very much for the invitation. And after your, what I would say, overheated introduction and flattering introduction, I'm going to lean into the wind a little bit. I'm just looking through the program. I noticed that I'm possibly the only speaker who is not and never was a central banker, is not and never was a researcher. I am a career civil servant, guys. There's still time, yes, but unfortunately running out. And nowadays I do lots of things. I do a bit of macroprudential, a bit of microprudential, a bit of economic analysis, a bit of legislation, and I do it across all the financial sectors. So I am certainly not a macroprudential expert in the sense of this conference. I am, I think, what in the Irish civil service they call a gifted amateur. And I'm amateur, maybe not so gifted, but at least I'm amateur. But the Commission is, however, responsible for the legislation that underlies the macro framework, and we're responsible for reviewing it. So it's been very interesting to be in this conference. It's been interesting to hear what is being said. I've tried to cross-reference various things I heard today and made a complete mess of my notes, so you may pay for that as I go along, but I will do my best. I've also gone one step further than Paul. I don't have just no formulas, I have no slides at all. So, let me start by saying what I was asked to speak about. I was asked to speak about the ongoing review of the legislation underlying the EU macroprudential framework. And what I'll do is I will draw quite heavily on what we have taken from the consultation. Some of my own prejudices may come through, but you'll have to guess exactly what they are. What was the starting point for the review? Well, let's start with timing. It's been about 7 years since we started this exercise, so I guess it's time to look back. In terms of history, I think we have to be honest and say that the EU macroprudential framework has developed in circumstances which were not usual and perhaps not ideal. The ESRB, which was the first element put in place, that was established basically in the middle of a crisis. It was established in the middle of a crisis which ordinarily would have been expected to prevent if it had existed beforehand. So it had a sort of difficult existential birth, I think. It found it, I think, quite difficult to find a role in a rather crowded institutional space. So this has been mentioned already, that the tools we found that the macroprudential framework used turned out to be rather microprudential in nature, applied, of course, at a macro level. So it had to kind of find its way into this institutional framework in the EU. Because of that, we opted not to give it binding powers. We opted to give it comply or explain powers. This is because we knew it would bump into other important policy fields like taxation and others. And it would be better if it used moral suasion rather than create a sort of conflict. It was, of course, also a very new animal. There had been some experience of these frameworks in other parts of the world, but none in this part of the world. And so the legislation we put down was fairly light. If you compare it to the legislation we put for the microprudential supervisory authorities, it was very short. And that's because we felt it was better to allow this new animal to sort of evolve organically into its environment. But that's another reason why I think you have to come back now, 5 or 7 years later, and have another look. A second consideration here in terms of history is that the macroprudential toolbox was in a sense developed in another place. So it was not developed inside the ESRB, it was developed in a discussion of the CRD, CRR, which was a microprudential forum. And so the result of that is, of course, that the macroprudential tools are spread across the piece of legislation. They have similarities, but very different procedures, different triggers. So in the end, it makes for a rather complicated toolbox. Complicated even for those who use it, but completely unintelligible for those who don't use it on a regular basis. So that, I think, has to be borne in mind as well. The reason we had this, of course, is because it was a very difficult debate around macroprudential tools. And why was the debate difficult? It was difficult because macroprudential policy in the EU has a very specific challenge. And that is, you have to find a trade-off between, in a sense, the vocation of macroprudential policy in the EU, which is to manage national specific developments in financial systems, but you have to balance that against the need to preserve the integrity of the single market. So there has been this sort of balancing act throughout the process. And that is reflected, I think, in many of the decisions that have been made. The ESRB, of course, is a body which has to coordinate macroprudential policy at the national level. So it is the one that has to find this balance between national specific measures and the single market based on the rule book that we have given it. And in the consultation, there was a lot of comments about whether this rule book shouldn't be streamlined, shouldn't be made simpler, shouldn't be made easier to use. I think the question you have to ask on the other side then, that if we make the rule book more flexible to use, is the ESRB strong enough to manage the trade-off between what is needed at national level and what is needed to preserve the single market? So in a sense, it's a trade-off of institutional strength versus tight rules. So I think the stronger the institution, the more flexible your rules can be. And that's a little bit the thinking that comes through from the consultation. Of course, looking forward now, well, not looking forward, but more recent history, we had, of course, the creation of the SSM as part of the banking union, which has changed the geometry a little bit of the ESRB. We have a sort of macroprudential body within a macroprudential body, a very large one. It's also an issue that the ECB is both micro and macro supervisor, potentially. So these are all things that banking union has changed, and Vítor feels we didn't go far enough. We thought we went far enough, but it's a consultation, so you're entitled to consult. Now we have CMU, which is another reason why we have to think about the macroprudential framework. Do we want to expand the scope or not? And then we have Brexit, and that is the one and only time I will mention that. But of course, it is relevant to the macroprudential framework as well. So I think if you look at this history, you see that macroprudential framework was built sequentially and on a very piecemeal basis. So it is kind of, it wasn't that we were able to focus on it and create a coherent structure at the same time. We had to do it in pieces. And so it has turned out, I think, to be pretty good, but there's obviously scope for incoherence and inefficiencies. And the questions that came through the consultation were questions about, could it be made more efficient? Can it be made more transparent, more accountable, more comprehensible? I think this is important because, as Sharon said earlier, and others have said, Macropru can have important distributional effects. It's not just about financial stability, which is delegated to somebody. If you're making distributional policies, you have to be somehow transparent and accountable. Having said that, and all of these difficult starting conditions, I mean, the general conclusion from the consultation was that the framework is in fact functioning fairly well. So the ESRB is now well established. It has made many important inputs to financial debates. It has issued warnings and recommendations. The toolbox is being used. In fact, it's being used more than I thought it would be used, which is an issue because when you have complicated procedures and you're using these tools, it means it's a very complicated policy work. So again, this is an issue about complexity versus simplicity in the toolbox. I think macroprudential policy has proven particularly relevant in the post-crisis environment of low interest rates. So it has allowed, perhaps counterintuitively, it has been able to operate against monetary policy in some ways and to compensate for what was not there. And it's also been particularly useful in the euro area, of course, where member states have a single monetary policy and therefore it has a more sort of longer-term vocation. So I think overall, what's coming out of the consultation is that the idea is not to revolutionize the framework, but to refine the framework. So we'll look for specific areas in which you can enhance its functioning. And I think that is the message that we're taking from it. So we're not talking about revolution, we're talking about evolution and refinement. Now, looking at the review itself, you can say it's both timely and premature. It's timely because, as I said, the consultation comes 7 years after we started. It has also indicated that the institutional environment has changed, particularly with banking union, but also CMU. You see from the consultation concern about notable diversity, notable differences and inconsistencies across member states in how they're organizing macroprudential. It is not even the case that all member states have the same authorities in charge. So in some cases you have central banks, in some cases you have committees involving ministries, treasuries, in other cases your committees not involved in treasuries. I think there's one or two cases where the Minister of Trade or something is also involved. So it's a very diverse structure, and that was noted in the consultation. So in a sense, and also this complexity in the toolbox has come out very much in the consultation. It's premature, on the other hand, because I think we've not really seen the framework operate over what I would say is a normal financial cycle. This has been a post-crisis period. So we've had low for long interest rates, we've had a lot of legacy issues which make macroprudential policy that bit more difficult to operate. I think it's more difficult to do what the Central Bank of Ireland did in a legacy situation than it might have been in a more normal financial situation. So again, we have to take that into account when we look at the lessons that we draw from the functioning so far. So where are we in the review process? Well, we've had the public consultation last year, to which Vítor thankfully replied. We had a hearing last year as well, a public hearing, and now examining, based on that consultation and that hearing, what we think are the appropriate measures to put forward and what's the appropriate timing. I will highlight just a few kind of preliminary findings that we're taking from the consultation. First, there's a view that the ESRB is performing quite well, so there's no need for massive overhauls. But it is a very large operation. I think it is large because I remember Andrew Crockett saying to me at the time that during a crisis nobody does not want to be around the table, so you end up with 80 people around the table. But in normal times, some may drift away. But of course, since we're still running through the legacy of the crisis, we still have everybody around the table, and it is a very large body. And therefore, we need to look at ways of making it more efficient in terms of its decision-making, perhaps streamlining some of its procedures. We must look at expanding its expertise. So if we're going to go into the non-bank space, is the current bank-centric structure the right one? Because it is very much built around central banks. And it struck me when I was listening to Paul this morning when he was talking about delegated agents. Where does the Treasury fit in all of this? We, of course, in our structure of the ECB, did not include the Treasury. They're observer members and they're represented by the chairman of the EFC. Whereas we go to the United States, where the FSOC, the Treasury chairs the FSOC. I've had a lot of discussions with colleagues in the United States, and we've not been able to work out which of these really is the best model or the most functional model. But it is interesting to know where Treasury fits around the financial stability debate, because that's also coming out from the consultation. I should say that when we come to the ESRB, what we can do in legislation is to change the structure of the body. We cannot change its internal functioning. That's something which is for the body itself. But to the extent that we can help that internal functioning by making discrete changes in its structure through the law, then we'll be willing to do so. On the toolbox, again, the general view was that it's working, it's being used. I listened carefully both to Paul and to Sharon. It's interesting that they both approach the same problem, but they have different approaches to it. And that may reflect national specific requirements, or it may just reflect different ways institutions approach things. That may not be a problem if they're all consistent, but if we're all using the same tools in a different way, we have to be careful that these don't create tensions and that these differences are fully justified. The question also is, do we need so many procedures for these capital tools? We have 5 capital tools, we have 5 procedures, we have 5 triggers. 4 of them are structural and 1 is counter-cyclical. Okay. Maybe there is a big difference between an OSI and a GSI buffer and a SRB, but maybe there isn't. And I think we have to probably look at that at some point. Maybe not now, but at some point. One issue which was brought up here, and it's just to show the sensitivity of the debate, is the use of Pillar 2 for macroprudential. As you know, in our proposal last November on Basel III, we put in a proposal not to allow Pillar 2 to be used for macroprudential purposes. But that has met with considerable resistance from some member states who see that as a loss of flexibility. So this is just an example of the kind of sensitivity of the debate. And then the last point I will make here is to say that we will look at the expansion of macroprudential beyond banking. I think we clearly have to look at this, particularly in the context of CMU. But as we heard from the debate earlier today, this is still an ongoing discussion. I get the impression that, and I see this also in the FSB, that the argument over whether or not and how you manage the non-banking space from a macroprudential perspective is still not closed. I think we all kind of agree that shadow banks are in, but we can't agree on exactly what shadow banks are. And I think until we get these sort of decisions clear, we will have to continue to analyse. But obviously, when we get that clear, then we'd have to consider what are the sort of instruments that we would need to put in the hands of the macroprudential supervisors. And then a CMU angle there would also be important because it would now be a single capital market. We might face exactly the same problems as we faced in the banking side in terms of trade-offs between national and single market considerations. So with that, I'll conclude by saying, in our view, the framework is still quite young. It's only 5 to 7 years. I think it has functioned pretty well given the atypical environment it was in. I think this atypical environment makes assessment a little bit more difficult, so it's not so easy to find the right benchmarks against which to assess it. So this makes, a kind of categorical assessment a little bit more difficult. We've had the consultation. As I said, what's coming from the consultation, and I think we agree, is that it's not about ripping up the framework. It's about refining the framework. And the key issues are going to be, in my opinion, around governance, around this balance between the single market and the national specificities, how to streamline the toolbox, and how to consider these new tools, loan-to-value, etc., because they are very different from capital tools. And they also, as I was reminded before I came here, they have different legal bases in different member states, so we also have to take that into account. And then lastly, my own bugbear is that I think we have to make the whole process more transparent, more accountable, more visible, partly because it's the right thing to do. Macroprudential policy has implications for distribution in society, but also if you want to convince the people that macroprudential policy has a role and a legitimate role, then you cannot do it, I think, behind closed doors. Thank you, Vítor.
Thank you very much, Sharon. So I now open 5 minutes, any questions among the members of the panel, and then I will give the floor to the audience. Any remarks to some of the other interventions? Fernando, please.
Yes, thank you. On these distributional effects of macro-pro policies, I'm glad you put it that way, Sharon, because macro-pro policies, as many other macro policies, do have actually distributional effects. But I think I like the way you put it because sometimes it's actually presented in a different way, which is some macro-pro policies have more distributional effects than other macro-pro policies. For instance, with reference to loan-to-value or loan-to-income, they are considered to be especially regressive and therefore to have these distributional effects. And often this argument has been used, actually, for instance, not to give these instruments to other than the domestic national authorities because they are politically too sensitive to some extent. So you can understand the sensitivity, but in terms of the impact on distribution, I'm not convinced that they have a more significant impact than any other macroprudential policy that by definition is there actually to restrain credit growth in the expansionary phase of the cycle. Of course, the ones who are going to suffer more from this sort of tightness of the credit supply is going to be people with low income. Otherwise, actually, macro-pro policies are not going to work, full stop. So we should not exaggerate. We should understand actually distributional impact of macro-pro policies, but we should not try to refrain from using that in order to favor some instruments against the others.
Yes, thank you. So now I open the discussion to the floor, to comments, remarks, or questions to any member of the panel. Paul, yes. Good.
2 comments, but with a question mark at the end. Sean mentioned FSOC in the United States in the context of the role of finance ministries. My observation while I was in office, and probably even more, spending more time in the United States, is one of the many reasons, but one of the big reasons the FSOC is so controversial in the United States and in the Congress, which it is that it is perceived by the minority party in Congress, particularly in the House, but in the Senate as well, to be the creature of the administration. And this is reinforced by the structure of their independent regulatory commissions, not the Fed so much, where to characterize them as the minority party members of those commissions see their majority party chair going off to a meeting chaired by an administration treasury secretary and chairs of the other regulatory bodies appointed by the same party. And they object to that, and you'll know about the famous incident where one of the SEC commissioners turned up and demanded to be, I don't know how well known that is over here. I mean, every member of Congress would know about it. So it's a highly politicized body. And so whatever you do, be careful about politicizing whatever the Euro area's or EU's macroprudential body is. The second point about distribution is, as Fernando just put it, I mean, that must be right, what you say, although I think there's a very important distinction between distributional effects and distributional choices. But I think that the underlying distributional issue isn't just about inequality, it's about the effect on individuals. If an LTV cap is introduced and it is absolutely binding and it is framed in a certain way, it doesn't matter whether somebody owns a field or has an inheritance coming or something like that. They had the particular circumstances of their conditions are irrelevant to the fact that the cap binds, they can't borrow. That is absolutely not true for raising capital or risk weights that flow through to the price of credit, because the price of credit, as applied to particular individuals, will take into consideration the particular circumstances of the individual. And I would say, looking back, the reason that Mervyn and I were opposed to our having the power, when it was we, as it were, to apply LTVs or LTIs directly, wasn't distributional effects in the way that Fernando has framed it, although that played a part. It was binding rules determined by non-elected people, binding individual households and firms in ways that could not take account of their particular circumstances. Whereas if you work through indirect mechanisms, interest rates, capital requirements, risk weights, etc., the people that make those judgments about individuals' access to credit and the terms of it is the private sector. And that seemed to us to be a more sustainable position. And where this will get tested, to link the 2 points together, is where one of you does something and the people that oppose it are in government, and that they were not the government that introduced or were party to introducing the macroprudential regime at EU level or at national level. And eventually, somewhere in the advanced world, a government is going to attack a macroprudential policymaker for hurting their voters, their base. And that will be something that, you know, will be pretty difficult when it happens, as it will, I suggest.
Thank you, Paul. There is nevertheless another element to that question of the consequences of LTVs, ETIs, and so on, which is that they are not per se necessarily prohibitions for anyone to borrow. They just have to have more down payment. They have to save a little more before they can get the loan. But they are not excluded per se. And whatever are the conditions of inequality that exist before this question of provision of loans for housing, that's something that depends on other subsystems in society. That inequality, that means that either by a big increase in interest rates or by having some rule about DTIs, well, some people don't have immediate access and suffer as a consequence of the inequality that pre-exists this. And of course, these measures are taken under a mandate that has a trade-off with another valuable social objective, which is financial stability in general. So, and that's why there is legitimacy to introduce some limitations, as we introduce limitations to circulation of cards and other things in the name of other values. So just to say that it is indeed, as you hinted, not just a matter of pure distributional immediate effects. I agree with that, but it's indeed a complex issue. And in the end, what makes the difference is that individuals and public opinion immediately understand the restrictions coming from an ETI or an LTV, and they fail to understand in the same easy way the restrictions or difficulties in getting loans just because there was a change in monetary policy in general. So, and the fact that they then understand quicker and react then leads the policymakers more aware also of not involving central banks, for instance, in all the controversy that this sort of more concrete measures entail. So, but okay, it's a nice point that it's not just pure distributional consequences. Anyone else? Yes, please, over there.
Thank you. I think we have to recognize that something else a bit is talking about EU and something else is different about the Eurozone, because Fernando's presentation seems to suggest that this is the same, but I think it's a bit different. As regards the division of the powers between the, let's say, center and national authorities, I think that there are more arguments for structural type of measures to be taken on the center level than actually the cyclical. I mean, the examples of Ireland and the Netherlands are clearly showing that you have a difference, and you have to have these instruments at the national level. However, if we are talking, for instance, about the SIFI surcharges, it's very difficult to judge what is their SIFIness from the level of the national authorities. It's actually, as a matter of fact, you have to take into account the effects on other countries, the interconnectedness, all this stuff. So I think that there is more arguments to bring this type of the powers to the level of the center. And as a matter of fact, they are more alike microprudential type of measures than macroprudential type of measures. So maybe this is an argument that at least in context of the Eurozone has to be taken into account. As regards the Pillar 2, I think that some of the concerns that the countries have raised in response to this idea that it should be rather primary, the microprudential, I think is that there are still a lot of, let's say, excessive procedures related to the use of systemic risk buffer. So if the systemic risk buffer will be more flexibly used, so I guess there will be less concerned, let's say, to leave this Pillar 2 measure to the micro supervisors. But I agree here that if you are using macro stress test, top-down ones, to calibrate this Pillar 2, it's like a macroprudential tool. So maybe the question is a bit different. Maybe we should use in context of calibrating this type of the measures, bottom-up process, taking into account the risk of portfolio of individual institutions, and then by applying this top-down macro stress test, give the macroprudential authorities to top up more the buffers in where this is needed. Of course, this is a proposal to be thought over, but I think that maybe we can do this way. Thank you.
Anyone in the panel wants to comment on this Pillar 2 thing?
I can.
Yeah.
I mean, the logic of what we put forward was that Pillar 2 is bank specific, okay, and therefore, we have to be logical, and using a macro stress test to apply this across the system is not. So, I mean, I'm not against using some bank-specific measure to boost the Pillar 2, then it's Pillar 2 and that's it. But to sort of, our problem was that people were using Pillar 2, which are bank-specific measures, for the system as a whole. Yeah. We are aware of the arguments that people want flexibility in other areas. That's all been taken into account. I just use this to show that there's a degree of sensitivity around this trade-off between their flexibility at the national level and what we can control. Just to come back on Paul's point about because they're kind of linked in a sense. In a sense, the way we put together the ESRB, we would have given LTV to the ESRB because we would have assumed governments would not have wanted to do it. So we're back in this world of independent organisations. But I think because of these distributional effects, now that we review it, there has to be a way of, these are important distributional issues, so there has to be a way of making these decisions somehow transparent and accountable. So either it's done through the independent body being more accountable, or we have I don't want to say the political side, because it's not necessarily political, but it's the Treasury side somehow more involved. Now, I think in the United States, we have two extremes. The FSOC put the Treasury in the chair. We put him in the corner, basically. Now we have to see if there's a sort of middle way where, or if not, then we have to go the other route, which is to see how we make more accountable these independent macroprudential agencies, more transparent and more accountable. That's how I see it.
In our opinion, we have supported this idea of dedicating Pillar 2 to its initial logic, which was to cater for idiosyncratic risks of individual institutions and, separate that from other measures taken in the name of the macro problems for the system. But I know that both Sharon and Fernando want to also say something about these questions. Please, Sharon.
I was going to go back to the issue of accountability and who has the responsibility and so on. So as I mentioned in my remarks, the measures in Ireland were subject to intense public debate, political debate, the media, a very significant amount of scrutiny from the time we mooted introducing them through a public consultation. And I think this has been an important element of why the bank has tried to be so transparent about the work. So firstly, an important dimension, I think, was giving responsibility to the central bank as an of the measures, to be very clear about what we mean by having evidence about the measures. What, are they being effective? What side effects are they having? And we've published very extensively on that. And we have tried, I think, also from a communications perspective to engage regularly around what we're doing, why we're doing it.
Well, the Irish experience also underlines the fact that in Europe there are totally different choices. There are several countries that have given these instruments simple. No agency has the independent power to use these instruments. So there are all sorts of institutional arrangements. Fernando, please.
be Sharon, and it's in the context of redistribution, but also transparency and accountability. It's a very specific question. I just wondered if you could comment on the action that was taken right at the end of December last year by the Central Bank of Portugal, which took 5 pari passu bonds out of more than 50 and transferred them from a good bank, another bank, into a bad bank, which effectively wiped out the shareholders in those bonds and transferred the assets to the ones remaining in the good bank. We think that the action was founded on the assumption that the bonds were high denomination and therefore institutional, but in reality, the end investors in those bonds are investors investing in mutual funds and pension funds. The assets are just aggregated and invested by a large intermediary acting on their behalf as an agent. So I just wondered if you could comment on that.
I don't know exactly the details of the situation. I prefer to.
I'm not sure it was.
I think. Any other question? Well, I conclude that there are no other interventions, and I understand. Let me say, just as a final remark on all these issues, not to have fulfill is that we use our models to calculate the spillovers to other neighboring countries of measures taken by a particular country. And that we then share that and discuss that in our Financial Stability Committee. So it's another important role of coordination by analyzing these spillovers. But I stop here. And that's the end also of our conference. I want to again thank all the speakers and the discussants to have accepted our invitations to be here. Particularly, if I may, I would like to thank the strong representation that we had this year from the other side of the Atlantic, and perhaps I could also start saying from the other side of the Channel. But that would be already perhaps premature. But indeed, we appreciated that strong representation came this time from the US and with great contributions to our debates. Let me also thank the organizers of all the conference, Clémence Benamar, Monica Bermudez, Silke Köhler, and Maria Udina, who were indeed very active in organizing all the aspects of the conference that went very smoothly. And finally, we already have decided the dates of the next year's conference. And so please reserve in your calendars that we will have our annual conference next year on the 17th and 18th of May, and everyone here is already invited to come. So thank you very much.